Australian investment property market may be entering a two-tier tax treatment era. Hello, I'm Len, your trustworthy accountant. Many investors may not have realized this yet. Australia's property investment market could be moving into a new era, where new properties and established properties are treated very differently for tax purposes. In the past, if your investment property made a loss, that loss could generally be used for negative gearing, meaning it could help reduce your salary income for tax purposes. But after this budget, the logic may be changing. In the future, if the property is new, it may continue to receive full negative gearing benefits. However, if that established property may only allow the loss to be carried forward. So what does this actually mean? For example, there are two persons, both of them earning 120,000 per year, and own one investment property that incurs an annual loss of 20,000. The first person buys a new property. The other buys an established property. Previously, both investors could use that 20,000 loss to reduce their taxable salary income. But in the future, the investor who buys a new property may still be able to reduce taxable income immediately and receive tax benefit sooner. By contrast, the investor who buys an established property may not be able to offset that loss against the salary income straight away. Instead, the loss may lead to be carried forward and used later against the rental income or future capital gains. On the surface, this looks like a tax rule change. But in reality, it could create a major difference in cash flow. The same 20,000 loss may be treated very differently. One investor receives the tax relief sooner, straight away. The other has to carry the cash flow pressure on their own, could be 2 years later or 20 years later. So the real question is no longer simply, should I buy an investment property? The better question is, am I buying into the same investment again? Going forward, investors may need to look beyond location, rent, and capital growth. They may also need to consider what's the after-tax cash flow. This means we should ask, is this property new or established? Can the loss offset my salary income immediately? Can I afford the holding cost after tax? And when I sell, will the next investor calculate the return the same way? Because in the new property market, tax treatment may become one of the most important factors shaping investment decisions. We specialize in FABC compliance and tax planning, helping you optimize your asset structure and stay ahead of budget changes. If you have a family trust, investment property, FABC builder structure, or would you like to understand how this budget may affect you, feel free to book a 15-minute consultation. Please don't forget, click, save, and like.